Canaccord Genuity's Team LWC. Great to see you, Chris. Thanks for joining us.
Thanks for having me, Andy.
Start off with Metro, if you would. Is it a stock that's attracting you right now?
It's not really eligible for us because of the dividend being below 2%. In Canada, we run a Canadian dividend mandate, so just a little bit low there, but certainly been an outperformer this year. Encouraging pharmacy sales today, strong year-over-year total sales. So great defensive name for these uncertain times.
Right, but you like to see a dividend yield of at least 2% on stocks you buy?
We're actually targeting more of the 4% range,
Wow.
Those high dividend payers with consistent dividend growth. You can think of the banks, some of the insurance companies, real estate investment trusts, things of that nature.
Let's have a look at some other stocks you do like. Meta Platforms, that stock down from its highs like so many tech names, but a darling among investors who think AI is going to be huge for certain internet giants. You do favor Meta Platforms right now.
Yeah, Meta is one of our favorite in the Mag 7. Been hit a little bit here by some FTC antitrust competition bureau issues. That on top of just general weakness in the overall tech sector and stock market has drawn this down. Our Canaccord target price is $8.25, so about 60% upside here. The other issue is, the ad spending weighing on the overall sector. It's a big component of how they make money. We think that Google's probably a bit more exposed to the declining ad revenue, particularly as OpenAI, ChatGPT are taking away some search revenue. We think some of those budgets could rotate to Meta. And we don't see this competition bureau issues really spurring up any further than they already are.
Okay, and the Goldman Sachs, you like the look of that one?
Yeah, Goldman's a name we've owned for a while. We're cautious going into earnings, wondering if they were going to ramp up credit loss provisions while they just reported earlier this week. But we're pretty impressed by earnings, continuing to see declining operating expenses mixed with increasing revenue. So even at a 12% revenue growth, we're seeing EPS growth on a year-over-year basis of 35%. Stock's way off of the lows. Their wealth management division has been picking up the slack from the lack of deal flow. That was really kind of pumping up the price of the stock coming into Q4 after the election. We think that at some point this uncertainty fades and companies get back to business, and Goldman, market leader on that investment banking space globally.
The Canadian Natural, that would be one of your favorites if you were looking for oil stocks?
Yeah, Canadian Natural fits the bill on the dividend side, yielding about 6%. Going to achieve double-digit production growth in a fairly low production environment here in Canada. Shareholder-friendly organization. Couple the dividends with buybacks. We're seeing low enterprise value to EBITDA, and we think that the oil price here is pricing in a lot of those recessionary fears. So should that dissipate, I think the price recovers. These guys recover alongside of it. And I think the tariff overhang is a little bit overblown with what's happening out there.
Yeah, I mean, for now, it appears Canadian Energy dodging the Trump tariffs. That had been a worry for Canadian Natural in particular.
Yeah, for sure. It was hard to understand how they were going to stick to the election promises of lower prices at the pump, but tariffing our crude coming down to south of the border.
Another idea you have is Netflix. It looks like, I guess, if the economy gets worse, we might be sitting home just watching dramas.
Yeah, I mean, I think that it's one of those recession defensive stocks. It's a lower price item. They have over 300 subscribers now. They just did an internal release hoping to make that 400 million by 2030, which they expect to more than double the enterprise value of the organization, which is about $400 billion now. They hope to be in the $1 trillion club by 2030. That's about a 1.5% increase, 1.5 time increase from where we are today. And they're come out as a clear market leader and have a very defendable moat because of their ability to spend on content and that diverse content reach around the world, which is a focus of theirs in the next few years, looking at countries that have good broadband where their penetration rates are a little bit lower.
I mean, you've told us about a couple of US stocks you like, but it sounds like you are looking beyond the US because of the potential of a weaker US dollar.
Yeah, we've been leaning into international stocks, particularly in the developed world, but also some emerging markets as well. We're not the best stock pickers all over the world, so we outsource that. We just added the Sun Life MFC International Value Fund. It focuses more on the value-oriented companies. I talked about the fact that we look at Canadian dividend payers here in Canada. We go to the US for some of the market-leading growth organizations, and now we're looking at Europe for some of those deeper value plays with a valuation discount. You mentioned a weaker US dollar, a stronger euro. We've seen the euro rally about 10% so far this year. That repatriates those earnings to us at a higher level. You add that with the valuation disconnect that's been there for a long period of time. Those that got in early, it's been a tough decade based on the U.S. outperformance, but we see a changing of that guard based on both valuations as well as fiscal policy, both between the United States and Europe.
Chris, we better jump. Thank you very much indeed for joining us.